With Trump imposing this tariff on India, how will that impact investing?
When there's a geopolitical uncertainties, and because of that market falls, then it's a good time to invest more money. And maximum wealth is always created when you invest at the uncertain times. So will that overall impact the country? The answer is no. But it will impact few sectors. The answer is yes.
Say somebody is under debt, how do they go about repaying that?
So what I always say is that first SIP was first investment start in liquid fund.
Should I straight away start putting that money into SIPs?
First goal, okay, is your emergency fund. I should have my 3 to 6 months expenses in very liquid assets.
What can they do to best invest their money?
Whatever money you have, right? You have to divide your money in primarily three buckets. 30% of your money should go for your long-term goals, right? Which is a financial freedom. Then obviously lump sums will score far better over SIPs. What I always say is like a traffic light signal. Market also gives you three signals: red, yellow, and green.
What are some four ways by which people can take control of their finances?
Okay. So, Sanskar, first thing what I always say is that is for everyone. Okay. First thing what you should do is that where do you stand today? Right. A lot of people say, okay, I've done some investments here, I've done some LIC policies here, I've some investments here and there. Right. But actually, people don't know where do they stand today. What is their overall asset allocation in today's term? Right. So first thing is that write down, bring every investments in one place and see, okay, where do you stand today in terms of your cash flows, in terms of net worth statement. Okay. So once you've compiled everything in one place and you know that this is the assets you already have and this is your asset allocation. Then comes the second thing is that, okay, I've got this money, but what is the purpose of this money? Right? Why I need this money? Okay. So this is where we call as define your goals. That what are my goals in my life? What are my aspirations in my life for which I need money? Right? So that's the second step what you should do. Then comes the third step is that, okay, I've got these goals and I've got this money. Try to map both to each other, right? That this policy is maturing in 27 and I have this goal to buy a car in 27. So this money will come from here, right? So for every goal, all your investments which you have done till now, try to map those investments with those goals, right? So this will give you a fair idea that what all goals are already achieved, what all goals are pending. Okay. And you will have a very clear idea that this asset is meant for this goal, this asset is mapped for this goal, so I should touch this on money only when this goal comes in, right? So that will define that, okay, you've got your overall goals, right? And then we'll tell you that what is the shortfall for every goal, right? And once you get the shortfall, then decide a plan that how I'm going to invest my money to achieve these goals, right? So if I have a goal after 5 years, I'll invest my money here. If I've got a goal after 10 years, this is the amount of money I need to invest for this goal. So you'll have a clear roadmap that what is the amount of money I need to save for each and every goal, right? And last and most important is review annually, right? So that what you have decided this year that I'm going to save X amount of money for this various goals. And after the year end, have you saved this much money? And how is that asset performing for every goal? So this is a four step what I always say. First, know where do you stand today. Second thing, get the purpose of your life. That what are your goals? What are your aspiration? Then map your goals and with your investments and see what is the shortfall. And for that, how much savings and investments you need to do every year on year. And last is that you review this in every year on year. So this is a four step which if you have done, I think your whole financial planning or whole your money is in very good shape.
So essentially, what you are saying is people should focus on goal based investing.
Exactly. So see, all money has to have a purpose, right? If you don't know where you want to reach, whichever road you take is all good, right? So if you do not know that for what is the purpose of this money, what is my goal, and once you have defined that goal, then accordingly you should invest your money, right? Because otherwise there's nothing called as good or bad in terms of investments. It's all dependent whether it's good for me or not, right? That will only based on what your goal is. What is the purpose of this money? And accordingly, you need to invest your money. So I've seen a lot of people who invest in XYZ products, okay, and then because they don't have a clear goal, if the market goes northwards, right, or southwards, right, depend on right, they either get greedy or they become fearful, right? And because they don't have a goal in mind, right, they don't know when to redeem or when to add more. Okay, so that's where always a dilemma comes in. So once you have a very clear goal that I need this money after 10 years, And even if the market have gone down, why should you be worried about it? Because you need money after 10 years, you should continue to invest your money. And once you are near to your goal, which is right, you should start withdrawing money from your aggressive assets to conservative assets. So once you have a defined goal, you can do this asset allocation. Otherwise, you will always be either greedy or fearful when the markets move up and down. And because you don't have a purpose with the money, right, you don't know whether what you've done is right or wrong.
What's an aggressive versus an conservative asset?
So aggressive asset basically means you are investing in a product which is like an equity oriented assets. More of equities, because equity markets goes up and down. It depends on the market scenario, right? Economy and everything, right? Whereas conservative assets are like when you're investing in fixed income, where I get a fixed return. So in fixed income, your returns are capped, right? You don't get upside potential. Whereas in equity market, you can get upside potential, right? But where your returns are not fixed, the even you can have a downside. So that's called as aggressive assets. Whereas conservative assets are where my returns are fixed, like a fixed income. And so this is how you define your asset classes.
Do you feel that with credit cards, EMI options, buy now pay later schemes, people are gonna fall more and more into debt traps?
The reason is that people don't know that what I need, what is my difference between my need and want, right? Your needs should be can be met by your salaries, the income which you're drawing. Now, doesn't have any limit, right? Today you may want a BMW, tomorrow may want a Rolls Royce, and the third day you may want something else, right? So your want will keep on changing, right? But your needs are something which are changing. Now your salaries can make sure that your needs are done to a large extent, right? But there's no end to the want, right? So now if you start taking loans for your wants, that's a big problem. Then you fall in a debt trap, right? So you need to understand there's a good debt and there's a bad debt. What is a good debt? Like your home loan, right, is a very good debt, right? So you should, when you're buying a house, because you're getting an asset. So if you're taking a loan for your house, it's a good debt. So then it's good. Then there's no problem. But if you're taking a loan to buy a car or to go international vacation, right? So then it's a bad debt. Why? Because those are depreciating assets in terms of your car will depreciate after 5 6 years. You're not creating an asset, right? And you're taking a loan against that, right? Same goes for say vacations or same goes for holidays, right? But if you're taking a loan for education, if you're taking a loan for home, it's a good debt, because if you're taking a loan for education, you will upskill yourself, and then you will have a better salaries going forward, so you can easily repay that. So if an asset is creating income, and then you can be able to repay the debt. But if an asset is not creating any income, then it's a bad debt.
Say somebody is under debt, how do they go about repaying that?
So the first thing what you should always do in the whole process, what I say is the first to repay your debt as much as possible, the bad debt, the debt which is not good, right? So what I mean by that, say for example, you have a credit card outstanding. The first thing what you should do with your income is that pay your credit card outstanding, because your credit card interest, what they charge you is roughly on 36%, which is very very high, right? The second thing, if you're a salaried employee and buying a car, that also costs you like 10 to 11%, right? That also you should pay off. You should not carry, because car is again not giving any tax breaks. So you should, whatever debt which is not good, right? You should try to first pay off all those debts and then think about investing, right? And a lot of people think that okay, I'll take a debt and start investing, right, or start doing trading. I'll make more money than that. That's the most disastrous thing you can do for yourself, right? Because what SEBI has also given us data that 93% people have not made money by doing trading. If you have taken loan and then done a trading, right, you have lost your interest cost also, and you have lost money on the investments also, right, in terms of trading. So please do not take loan to invest the money, right, in terms of doing trading and all. And second thing, don't take a loan to meet your wants, right? At times, you have to take a loan to meet your needs is acceptable, but not to meet your wants.
So say I start making money as a young professional. Should I straight away start putting that money into SIPs, or are there something else I need to check off before investing?
The first goal, okay, is your emergency funding. Is your call as contingency funding. Okay. Now, what is contingency funding is that at any point of time, I should have my 3 to 6 months expenses in very very liquid assets that I can able to withdraw that money no matter what happens. Like say for example, if someone lose a job, right, or met with some emergency in the at the home, right, then he will need money immediately, right? And because if you don't have emergency fund, you normally go and swipe your credit card, and which is a very very high interest cost, right? So what I always say, first create an emergency fund, right? So at least your 3 to 6 months expenses should be in a liquid fund, right? Beyond that, your and then you can do a long term investments. So what I always say is that first SIP was first investment start in liquid fund, right? Create an emergency fund, and not necessarily you'll create an emergency fund immediately. It may take you 12 months to create that emergency fund. First, create an emergency fund over next 12 months, and then also start an SIP for a long term investments. But not all your money can go for long term investment, because first you have to create an emergency fund. After that, you can start thinking for long term investments.
I want to talk about somebody who is experienced, who has good, let's say, who are above 40 years of age, but they were till now not aware about SIPs and investing. And they have, let's say, 7 to 10 lakhs in their savings account just because of pure ignorance, because they were ignorant. So now, what can they do to best invest their money?
See, whatever money you have, right, you have to divide your money in primarily three buckets. First bucket is emergency funding. Second bucket is called as short-term goals, and third bucket is long-term goals, right? And you cannot sacrifice one for the other. You have to do all the three things simultaneously. Okay. Now, a lot of people think, okay, I'll only start with one bucket and then start working on other bucket later. No, you have to start all the three buckets together, right? So as I discussed, your 3 to 6 months expenses should be in a liquid fund, which is the emergency funding or contingency funding, right? So if you know that okay, your household expenses is 50,000 rupees, over a 1 year period, you have to create a 6 lakh rupees corpus in a liquid or emergency fund, right? So out of your whatever money you have been saving on, you put partial money in liquid fund and say that every month when my income keeps on coming in, I'll put part of the money in my emergency fund. And over 1 year, 1.5 year, I'll create that corpus, right? Then the second bucket comes in is the short-term goals, right? So not all your goals are long-term. Some goals will be short-term, some goals will be long-term, some goals will be medium-term, right? So you have different goals, right? So then you create a second bucket where you put okay, out of my overall 100% savings, right? What do I save? I'll put 30, 40% or 50% my short-term goals, right? Which can be like a funding your vacations, funding your car, right? Your kids' education, right? That can be short-term goals, right? So part of the funding has to go for that goal. And mandatory 30 to 40%, 30% of your money should go for your long-term goals, right? Which is a financial freedom, right? So 30% should go for financial freedom. Another 10, 15% can go for kids' future education. 30, 40% can go for short-term goals, and 15, 20% can go for contingency funding. So this is how you need to divide the money for all the three goals simultaneously. Okay. So that's how you do something called bucketing strategy, where you have short-term, medium-term, or long-term, as well as your contingency.
ये तो ठीक है, bucket strategy तो हो गया. But let's say somebody has 7 lakhs buffer. So should they invest all of that lump sum into like lump sum or into SIP? कैसे करना चाहिए?
Okay. So if you already have a money, then obviously lump sums will score far better over SIPs over a long period of time, right? Because SIP will go every month on month. So compounding start once the money is invested after that. Whereas if you put lump sum money today, your compounding starts from today onwards. Now, whether to put lump sum money all together or staggered over next 6 to 12 months, that depends on market valuations. Okay. If say for example, if markets are very, very cheap now, right? So then you should invest all your money together. What I always say is like a traffic light signal. Market also gives you three signals: red, yellow, and green. Okay. What does green means? That markets are really very, very cheap. That point of you should put all your lump sum together. What does yellow means? Markets are fair valued. So you can stagger over next 3 to 6 months. And what does red mean? That markets are really expensive. Then you should stagger over next 12 to 15 months. So these are three signals which market gives you, right? Based on that, you should decide your lump sum strategy. So if markets are very, very cheap, invest all the money together. If markets are fair valued, stagger over next 3 to 6 months. If markets are really expensive, then stagger over 12 to 15 months. But that's a maximum staggering you should do for your money, right? And in because markets are expensive, they will go through ups and downs. And when you stagger your investments over 12 months, you average out your cost, right? And then after that, your compounding starts working for you. SIP is good for people who SIP is what you earn regularly, so you should invest regularly. This is where SIP comes in. Every month I get my salary, every month I get my income. From there, part of the money will go as investments, and which is where the SIP does the work.
So with Trump imposing this tariff on India, how will that impact investing?
Okay. See, whatever happens on a daily basis, right? Obviously, it impacts markets on a short-term basis. What determines market in the long term is the earnings of the companies, right, and the growth of the country, right? So now Trump imposing a tariffs. Okay, first look at overall what is the export we do to US, right? Overall, if I overall export what we do is roughly at 2% of our GDP. So will that overall impact the country? The answer is no, but it will impact few sectors. The answer is yes, like gems and jewelries. It may impact pharma, right? So it may impact some sectors, but not all the sectors of the country, right? And it's not that India, as in overall, what we export to US is like 2% of the GDP. So it's not going to impact the overall India, right? But in the short term, markets may fall or markets may go down, right? Because markets valuation is a little bit more than fair value. Okay, so markets may fall in the short term because of the nervousness in the market, right? Among the people. So what will happen is that market. So that is a good time to invest more money. So if anything happens geopolitically, right, which is short-term in phenomenon, right? That and then you know that either there will some negotiation, something will come on the table, and obviously companies will also know it themselves. It's not that if you have today everything. I'm saying when we have a hurdle, we always try to do something to cross that hurdle, right? The entrepreneurs are smart enough, right? If they have a tariff, they will try to do something. So make sure that we overcome that. And it's not only impacting India. The tariffs is across the world. So in some places, because if say for example Taiwan was doing something and the tariff is X percentage. And today, if the tariff in India is lower than that in the other country, then we can excel in those products also, right? And the role of an entrepreneur is to innovate, right? Is to cross the hurdles. So all that what we are talking about obviously will have a short-term impact, but over a long period of time, this entrepreneurs will obviously find a solution, will overcome this one, and markets will again come back, right? So whenever there's a noise like this one, right, and when there's a geopolitical uncertainties, and because of that market falls, right, then it's a good time to invest more money and average out your cost. And that is the time. That is the way. If you do that, will you create sustainable wealth over long term?
But how do you convince a new retail investor to invest more when the market is falling?
Premises which I always say is that what Warren Buffett says that be greedy when others are fearful, and be fearful when others are greedy, right? So when people are fearful, when there's uncertainty in the market, right, when the news flows are negative, that is where the market corrects, right? And maximum wealth is always created when you invest at the uncertain times, right? Now, what we need to explain to retail investors is that first is to have a goal in mind. Now, when is your goal? If your goal is 1 year down the line, 2 year down the line, then I completely agree that you should not be investing in equities, and this is not a great time to invest in equities. But if your goal is 10, 15 years down the line, right, then you only asset class which will create wealth over a long period of time, which will beat inflation hands down, is will be equities only, right? And the volatility is the inherent nature of equities. Okay, so if you're investing when the times are bad, this will give you far better return kicker as compared to when you're investing when the markets are really good, right? So you have to explain to retail investors that this when you need money after 10, 15 years, right, then this is a great time to invest your money. And and historically it's always proved that if you're invested during the COVID times, right, the uncertain times, after 5 years you have made maximum wealth. Same if you're invested during the global financial crisis in 2008, right, you have got the maximum return then, right? If you invested during the tech bubble time in 2001, you made maximum money after that, right? So every crisis will give you this opportunity, right? And you need to prove this with the data, right? That every time when there was a crisis, if you invest in those time, you have to hold for 3, 5 years, but maximum gain is always made during that time. Okay, since your goal is 10, 15 years down the line, why should we be worried about it, right? In our case, we always show our own portfolio that if there's uncertainty, I'm investing my own money right now, right? And if when you're investing your own money, then others also get convinced with that, and they start also investing their money there.
So there's two schools of thought. One is that you only live once, so spend money on that car, go on that trip. And the other one is that you will never be fully healthy, so save for a retirement. How do you suggest people should find a balance and manage their expenses at the same time live to the fullest?
Okay, so it's very simple, Sanskar. It's very simple to do this one, right? But 99% people don't follow this. Okay, what is the mantra for this one? The mantra is very simple. You earn, you save certain amount, you decide that amount, whether it be 20%, whether it be 30%, whether it be 40% of your income, and what is left to be spent, right? Now, what normally people do, people all earn, they spend, then what is left is saving. Now, when you're spending, you don't have any control over there. Since you don't have any control over there, you don't have any control over your savings. And when you're spending this money, you also feel guilty. Yaar, kharcha kar diya, kharcha kar diya. Whereas we follow other approach, which is a smart approach. I save 20, 30, 40%, whatever the money it is. So I've earned a lakh of rupees. I save, say, 30%. So I've saved 30,000. Rest 70,000 is to be spent. And you will spend this money guilty free, right? And with this 70,000, you decide that what all my goals are, what are my aspirations are. And I'll spend all on all these aspirations, right? And then no one will going to stop you because your savings already done. And you have a complete control over your savings. You will have a complete control over your spending, right? So just a very smart approach, right? You decide the fixed percentage that I'll save 30% of my money. Once you have saved that, you won't see in your bank account. You won't have any urge to spend that money, right? And remaining money has to be spent. So you will spend and go and spend that money guilty free, right? So there are a lot of people who only save money. I always say that don't only save money because there's no purpose to it, right? Money also has to be spent at some point of time, right? Try to find the balance between both the thing. The best way to balance is decide the percentage. I'm going to save this percentage, right? Keep aside this one. Remaining all the money, whatever is there, I'll go and spend that money. Right? So this is a mantra which I've followed all my life. I'm very happy doing that. So let's take a simple example. Okay, say you're 25 years of age. Okay, you say, okay, I can invest 1 lakh rupees every year on you. I invest till the age of 60. So roughly you will create 4.8 crores of corpus, assuming at 12%. Okay. Now let's play this game. You say instead of 25, I'll start investing from 26. Right? So you've delayed by 1 year. Okay. So how much you've not saved in the process? 1 lakh rupees. But this, right? So you've not saved 1 lakh rupees. So इससे क्या फर्क पड़ने वाला है? But because you've started instead of 26 instead of 25, your retirement corpus will be down by 52 lakh rupees. Because that 1 lakh rupees has not worked for 35 odd years. And if you delay by 3 years, at 28 is the right age to start investing. Once I get married, then I'll start investing. Right? So 3 lakh की सेव नहीं किया क्या फर्क पड़ता है? But your retirement corpus will be down by 1.41 crore of rupees. And God forbid, if you delay by 6 years, the 30 is the right age to start investing. Right? Your corpus will be half. In spite of savings for next 30 odd years, only by delaying first 6 years, your corpus is half. So that's why never ever delay your investing. Right? Start as early as possible. Right? That's the biggest mantra in investing. See, start as early as possible. Right? That's the biggest weapon. Okay, आपने start कर दिया, कुछ टाइम के लिए आप नहीं सेव कर पाए, so you can stop that investment, right? And let the money what you've already saved, let it grow. Okay, फिर कुछ टाइम वापस आपको पैसे आ गए, वापस you can start again, right? Now, but I'll just tell you a simple thing that if you've started early, how does it make a difference even if you started for a very short period of time? So let's take it to example, right? Someone start investing at the age of 20. He invests only for first 10 years, right? And then he stops investing, right? And someone who start investing after 30, okay, invest all his life. At retirement, right? The first guy will have a higher corpus than the second guy because he started early and the money just kept on compounding. Whereas the other guy saved for 30 odd years, but the first guy only saved for first 10 years, right? So whatever you can save as early as possible, just keep on saving that money. Right after that, if you for whatever reasons you're not able to save for certain years, you have taken a home loan, your kids have gone to school, your savings rate have come down, that's fine, right? But your earlier money which you already saved and invested, that will also compound and create a lot of wealth for you, right? So I'll say to every youngsters, right, the day you start getting a job, start investing that money, right? And invest in your initial years as much as possible, right? Later you'll have more responsibilities, so your savings rate may come down, which is fine. But whatever you invested in the initial years will take care of, will be like compound at such a big rate that you'll be astonished when you retire.
Sir, what does your portfolio look like?
Okay. So Sanskar, when I started investing, right? Me and my brother, when we started investing, so I've been following this mantra from my life. When my salary was 8,000 rupees also, I was saving 1,500 rupees, right? The same earning, saving, and spending, right? Then when we came to Bombay, when we started our own company, we started with 10,000 rupees SIP. But what is one thing which we kept on doing is that keep on increasing our SIPs every year. So as your income keeps on increasing, your SIP should also increase. So a lot of people have just started one SIP and then they've never increased their SIPs. I'll say you should increase your SIPs every year, right? So we started with 10,000, went to 20,000, went to 50,000, went to lakh rupees, went to 5 lakh, 10 lakh. And today, me and my brother, we do a total SIP of 40 lakh rupees every month, right? So for last 15 years, we have been kept on increasing SIPs every year. And because we only kept on investing our money, right? And increasing SIPs, today we are sitting at corpus of 55 crores of rupees, right? And now just so first 15 years we have worked for money. Now our money starts working for ourselves. Right? Next 6 years, apart from SIPs, the current corpus itself become 110 crores, right? Because of so this is what I always say that start as early as possible. And first 15 years you have to work for money. After that, your money starts working for yourself. And this is where the compounding comes in.
So, what's the best book, in your opinion, to learn about finance?
Okay. See, start with the one book which I always recommend that there's something called Psychology of Money. Okay. This explains you how you actually look at money, right? So by Morgan Housel, you should read that book. And there's another book by Nick Murray, which is called Inevitable Wealth, right? So that is another book which you should read, right? Then for advisors, there's another book called Game of Numbers, right? So I read that book. So I don't read too much. That's a one habit which I want to improve for myself. Right? I'm very happy that my daughter is reading extensively. And today morning only we had a discussion. My daughter is joined a book club where she have to read 10 books in a month, right? Right. So, but I didn't have that habit in my childhood. Right? I want to improve that, but I'll say for first timers, Psychology of Money, right, and Inevitable Wealth by Nick Murray. The first two books they should read these two books. And if you want to do equity investing, then you should read Benjamin Graham's book. But again, if from a personal finance perspective, I think you should start with these two books.
Also, on the topic of personal finance, how can somebody track their finances?
Okay. So the best way to track your finances is called as a net worth statement. Okay. So a lot of people say, okay, I've invested this money has gone up so much, this money has not gone up so much. You should be more bothered about that how my net worth has increased year on year. So what was my net worth last year? What is my net worth this year? Right? And how much that has increased. Right? And that whether your net worth has beaten inflation or not. That's the most important thing. Right? Because if, for example, you have so how you do this, right? All your liquid asset in one place, right? All your fixed income assets in second column, which includes your fixed deposit, EPF, PPF, LIC policies, right? Your direct equity mutual fund, PMS in third column, which is equity column, right? Your commodity like a gold and silver in fourth column, and real estate in your fifth column, right? So divide your money in these five brackets. That how much money I have in liquid, how much money I have in debt, how much money I have in equities, how much money I have in gold or commodities, how much money I have in real estate. So this will give you pure asset allocation. Now you should not be biased towards only one asset classes, right? If depending on your risk profile, you should divide your asset money, right? If 80% of your money is in fixed income, then it may not be if right, then it may not grow that much. And if your 80-90% of your money is in equities, that will be very volatile, right? So you need to understand what type of asset allocation you need to follow. And so every year write down this asset allocation, right? And then see, okay, so adding all my money, what is my assets minus my liabilities, okay, what is my net worth? And then you look at whether your net worth has increased every year on year, right? If your net worth is increasing every year on year, beating inflation, then you're doing good. If your net worth is not increasing in line with inflation, right, then you're not doing that great, right? So either you're increasing your liabilities too much, right, or you have asset allocation which is hardly beating inflation. So that's why I'll always say that write down your net worth statement every year on year and keep on tracking that. A lot of people always say I have some money here, some money here, but if you don't have a proper net worth statement, you really don't know that how what is your current standing and how is that growing over a period of time.
I feel that money is a very sensitive topic, especially in our Indian households. What do you think is the role of money in relationships?
So I always believe that 85% of our life problem are related to money, right? The lack of it, right? So you need to have reasonable amount of money, right, to maintain everything. Okay, 15% life problems are non-related to money, which no one can solve it, right? Which you have to do on your own. But 85% life problems are related to money, right? So this is why I say money is very very important, right? So make sure that you have a reasonable amount of corpus when you retire, so you don't have to depend on your children. If you're not dependent on your children are more than happy to stay with you or having to take care of you. But every time you're dependent on children, right, then you create a you become a burden for them, right? Instead of being I'm saying they always feel the burden about it, right? So you need to have reasonable money when you retire, right? Same thing if you can't provide a good education to your children, right? That's another big problem, right? Because they were born, at least from an education perspective, you should be able to provide them decent education, and that's where again the role of money comes in, right? Third is that when you are physically not fit, right, then you need a help you to manage the overall chorus. That's again the money is required to keep that. So I'm saying everything, if you look at broadly, money is required in all this angle, right? So money is a very critical part of it. So I'd say always say that 85% of a life problem can be solved if you have a reasonable amount of money.
What is the importance of one's credit score, sir?
So it's very important. So a lot of people don't give importance to credit score. Say that if I don't have to take a loan, why need to have a credit score? Right now, everything will be linked to credit score. So even if your employment, right, when they hire you, they look at your credit CIBIL score. So if your CIBIL scores is very bad, right, and you're defaulting on your loans, it shows that how indisciplined you are and your carelessness nature, right? So CIBIL scores gives you those insight that are you able to manage money well or not, right? If you're like if you're overpaying, if you're not paying every month on month your credit card bills and other bills, then you will always be in the stress. So if you already have a stress, how can you do good work in the organization, right? So I think even promoting you in the within the organization, they will look at your credit score beyond a point, right? That whether he should be is eligible for the higher promotions or not, right? Because credit score will also give you your overall standing in the market in terms of your credit liabilities, right? So I always say credit score is very important. One, to take a loan, right? That whenever you want to take a loan, obviously credit score is very critical. Second thing is that even your job or employment opportunities, credit score is very important. And even if you're a businessman, someone has to give you credit, right? They will look at your credit score, right? So for all the three angle, right, you need to maintain a very healthy credit score.
So, what are some practices young people can do to make sure their CIBIL score is maintained?
See, to maintain your CIBIL score, first is very that you have to make sure that your payments are done on the date and you don't delay even by one day, right? So one is that you can do if you already have the money in the savings account, whatever credit card you have swiped or whatever loans you have taken, if you already have that much money in your savings account, you can do a automated payment. So that on the day of a due date, your money is already debited from a bank account and gone to the respective whether the EMI or for the credit card, and there's no bounce in your statement, right? This is what I'll say. Auto pay is one of the best feature, right? For whatever reason you have taken a loan and you're not able to repay it, right? Try to inform the bank well in advance and try to negotiate them beforehand, if it's possible. Because if you keep on showing, if you don't only just delaying your payments, right, won't help you because that will impact your credit score very badly, right? And every year I'll say download your credit statement, right, and see that whether it's what exactly is showing. A lot of people they have paid off their loan, but they have not gotten a final settlement letter from the bank, right? And in your credit, in your CIBIL score, it may show that okay, this small outstanding line of 20 rupees, 50 rupees, 100 rupees, right? And that it will keep on showing that you're not paying that for a long period of time, and because of that your credit score goes down. So I'll say as a practice, every 1 year, every 2 years, you should download your credit score and see if there's anything which is showing outstanding. You must have thrown your credit cards, like you must have surrendered your credit card, but there may be some outstanding there, and then will show that okay, you have not paid that money and you're defaulted on that, and because it is your score can be down, right? So it's always good that whenever you're taking a loan, when you pay it off, get a settlement letter from the bank, right, that your loan is paid off, right? So that it doesn't reflect on your CIBIL score at any point of time and doesn't have an impact on your overall score.
Perfect. On that note, thank you so much, Nikhil sir, for this conversation. Thank you so much.
Yeah, thank you. Yeah.